Hello everyone. In this video, I'll explain how to substitute the corporate leverage with the shareholders leverage with a small example. Okay. So the concept here is how to substitute the corporate leverage with the shareholders leverage. Okay. There are two companies, N Limited and M Limited, having same earnings before interest and tax of rupees 20,000. M Limited is a levered company having a debt of rupees 1 lakh at 7% rate of interest. The cost of equity of N Limited is 10% and of M Limited is 11.5%. Mr. A is holding 10% shares in M Limited. Mr. B, a commerce graduate who is a friend of Mr. A, suggests to Mr. A that using leverage is risky. Mr. C, another commerce graduate, suggests to Mr. A that leverage accelerates the growth and increases the returns. Therefore, in the absence of leverage, returns would be less. So now here Mr. A is confused. One of the commerce graduate is suggesting that if a company uses the leverage, it is very risky because whether or not you are getting the profits, you have to pay the interest on the debt. Another friend is suggesting that if you don't use the leverage, your growth will be less. Now Mr. A is confused whether I should prefer the leverage or whether I should not prefer the leverage. So here this problem gives the solution. Both are correct. Leverage is risky. That argument is also correct. Leverage accelerates your growth or return. That argument is also correct. Now, which one I should follow? How I should trade off or balance between the both? So this problem is a perfect example to for that query. Okay, for that grievance, for the dilemma whether I should use the leverage or I should not use the leverage. If so, how? Okay, the dilemma will be resolved in that problem. Okay, right now, therefore. Mr. A seeks your advice as to whether he should continue his investment in M Limited or should he swap his investment in M Limited with investment in N Limited. Now, irrespective of whatever we are learning, the fundamental principle of earning profits is same. What is that fundamental principle? What is quoting at low, buy it. What is quoting at high, sell it. That a fundamental principle of earning profits will not change. Okay, don't make the concept complicated. Keep the concept as simple and as straightforward as possible. So therefore, the fundamental principle of earning profits is buy at low and sell at high. Therefore, therefore, out of two companies, N Limited and M Limited, which company should I buy and which company should I sell depends upon the value of the company. So the purchase the company whose value is less, sell the company whose value is high. Fundamental principle. Okay. So therefore, now I'll write the answer for, now we'll give the solution for this. Okay. Right. The fundamental principle of earning profits is the fundamental principle of earning profits is to buy what is quoting at low, less price, and sell what is quoting at more price. As simple as that. Any layman will know this point. Need not be financial expert. You need not be financial expert for this point. Any layman knows it. The fundamental principle of earning profits is to buy what is quoting at less price and sell what is quoting at more price. So therefore, now my next task is to decide what the value of each company, so that I can decide which company to buy and which company to sell. Okay. So now our next task is to determine the value of each company. Our next task is to determine the value of each company. Okay. Value of a company is equal to value of equity plus value of debt. Value of debt. Okay. Here, when I talk about value, we have to think about it as a market value, not the book value of the company. Because if I am selling the shares of the company, means I am not selling to the company. I am selling the shares of a company to somebody else in the market. Therefore, this value should be market value, not the book value. Be clear. When I am selling the shares of a company, means I am selling the shares of a company, but not to the company, but to somebody else in the market. So therefore, what I want is the market value, not the book value. That is the important point. Okay. Since Since the shares of a company are sold not to the company but to somebody else in the market, what we need is a market value, not the book value. Okay, so therefore both the value of equity and also value of debt, we have to compute the market values. Okay, right. So in the given question, the market values has not been given. In the market values has not been given. Therefore, you have to take the book value. Okay. In the absence of market value, the value of debt is taken as book value. The value of debt is taken as a book value. As simple as that. This is only for M Limited, because N Limited is not using any leverage. M Limited is a levered company having a debt of rupees 1 lakh at 7% rate of interest. Okay. Therefore, only for this company, the value of debt will arise. N Limited is an unlevered company. Okay, so for M Limited, the value of debt issue will not arise. Only for M Limited will take this value. Okay, and next comes to the value of equity. Even the value of equity is also same. We have to take the market value. But since the market value is not given, there are different methods of computing the value of equity. In the absence of market related information, there are different methods of computing the value of equity. Depends on the information given in the question. We'll use a particular method. We can use dividend based valuation, earnings based valuation, cost CAPM based, capital asset pricing based valuation. There are different methods of valuation. But in the given question, they have been given information relating only to the earnings. So therefore, I don't have any other option except to use this earnings based valuation. Okay, right. Based on the data given, based on the information given in the question, we will use earnings based valuation to arrive at to compute the value of equity, Okay, right. So this is what the theory. Be clear what you are doing. You should be conscious. Okay, you can't blindly solve the problems without knowing what's going on in the problem. Okay, right. So based on the information given in the question, we'll use earnings based valuation to compute the value of the equity. Okay, right. Now, when it comes to the market, we have to value the two firms, N Limited and M Limited. Then only we can decide which company to buy and which company to sell. Okay, now we'll compute the value of M Limited. So value of M Limited is equal to, okay, value of debt plus value of equity. Okay, so value of M Limited is equal to value of debt plus value of equity. Okay, see, value of M Limited is equal to value of debt plus value of equity. What is the value of debt? Already we have taken it as a 1 lakh. Because book value, as I told you, in the absence of market value, we are taking the book value. So given in the question, book value of debt is rupees 1 lakh plus value of equity. How to compute the value of equity? As I told you, based on the earnings based valuation. So if you use the earnings based valuation, earnings available to equity shareholder, divided by cost of equity. This will be same 1 lakh as it is, and this here earnings available to equity shareholders. So earnings before interest and tax minus interest, divided by K, cost of equity. KE refers to cost of equity. Okay, KE refers to cost of equity. EAS refers to earnings available to equity shareholders. So here, if you take same 1 lakh, earnings before interest and tax is how much? They have given 20,000. Earnings before interest and tax, they have given EBIT of 20,000 minus interest. So what is the interest? 7,000. 7,000 is the interest. Sir, how I have arrived 7,000 interest? Sir, very simple. 1 lakh debt into rate of 7%. 7,000 is the interest we have to pay. And what is the cost of equity? Cost of equity is 11.5%. So therefore, the value of equity will be same as 1 lakh. Sorry, value of debt will take same as 1 lakh, and this will be 13,000 divided by 11.5%. 13,000 divided by 11.5%. So that is equal to 1 lakh plus 13,000 divided by 11.5%. Okay, 13,000 divided by 11.5% means 0.115. 11.5% means 0.115. That will be 1,13,043. 1,13,043. 1,13,043 decimals. After 43, 4 is there. You can ignore it. Okay, 1,13,043. So therefore, total value of the firm is 2,13,043. As simple as that. Okay, so I have arrived at the value of one company. What is that company? M Limited. I have arrived at the value of one company, that is M Limited. Now my next task is to calculate the value of M Limited. Then only I can decide which company to buy and which company to sell. Okay, same value of N Limited is equal to same value of debt plus value of equity plus value of equity, value of debt plus value of equity. So here value of debt is 0 because N Limited is not using any debt. So therefore this will be 0. And value of equity is same, earnings available to equity shareholders divided by cost of equity. Earnings available to equity shareholders divided by cost of equity. Uniformity. For the sake of uniformity, you have to solve the problem in detail. Next, what is earnings available to equity? Same, earnings before interest and tax minus interest divided by cost of equity. That is equal to 0 plus earnings before interest and tax 20,000, whereas interest is 0 because no debt. And whereas cost of equity, what is the cost of equity? What is the cost of equity of N Limited? The cost of equity of N Limited is 10%. The cost of equity of N Limited is 10%. Okay, the cost of equity of N Limited is 10%. The cost of equity of N Limited is 10%, 0.10. That is equal to 0 plus 20,000 divided by 10%. That will be 2 lakhs. That will be 2 lakhs. So the total value will be 2 lakhs. 2 lakhs. So therefore, value of M Limited is 2 lakh. M Limited is 2 lakhs 13,000. N Limited is 2 lakhs, which is high. M Limited is high, sell it, and which is low, N Limited, buy it. As simple as that. No confusion. Sell it, sell at high, sell at more. Okay, buy at less, sell at more, buy at less. So what is the strategy? Sell the shares in investment in M Limited and buy the shares in of N Limited. As simple as that. So therefore, what is the strategy? Based on this information, what is our strategy? We have to sell the shares of M Limited and we have to purchase the shares of N Limited. Okay. I'll give at a single stroke. You can take the screenshot of it. You can take a screenshot of this description along with the answer. Okay. Right. Let me keep it in short as possible so that it is convenient for you to take the screenshot. Okay. This is the point, nothing more than that. This is the point. Okay. So you can take the screenshot of this, how we have completed what. Okay. Therefore, first we have to decide which company is selling at high and which company is selling at low. The company which is selling at high, sell it, and the company which is selling at low, buy it. Right. Now we have decided to sell the shares of M Limited and to purchase the shares of N Limited. Fine. So Mr. A is holding 10% shares in M Limited. Therefore, how much value he'll get? The total value of M Limited is we'll go to the next page. Okay, we'll go to the next page. The total value of M Limited is what is M Limited? The total value. So remember here, M Limited, A is holding what? A is holding 10% shares in M Limited. A is holding 10% shares in M Limited, not total company of M Limited. So therefore, you should not compute 10% of this 2,13,000. We should not compute 10% of this 2,30,000. We have to compute 10% of this 1,13,000, because what A is holding is only shares, not debt. A was not holding any debt. A was holding only 10% shares in M Limited. We have calculated the total value of the firm to decide which company to sell and which company to buy. Okay, right. So A is holding, Mr. A is holding 10% shares in A Limited. Okay, Mr. A is holding 10% shares in A Limited. How many points? Okay, fourth point, fifth point. From fifth point, we'll write. Okay. Mr. A is holding 10% shares in M Limited. So R will write, since the value of M Limited is more than the value of N Limited, Mr. A is advised to sell his shares in M Limited and buy shares of N Limited Okay, and buy shares of N Limited. Fine. Okay. Now, okay, right. Next, sixth point. Okay, A is holding the total A value of equity of M Limited is rupees how much? 1,13,043. 1,13,043. Value of M Limited is rupees 1,13,043. Mr. A is holding 10% shares in M Limited. Okay. Therefore, the amount Mr. A can obtain by selling his shares is rupees 13,000, is rupees 11,304. 1,13,043 into 10%. 11,304. Okay, this is what the point. Right now we have decided. Fine. Now the question is. So here we have addressed the concern of the first commerce graduate, Mr. B. What is the commerce graduate, Mr. B, concern? Who is a friend of a, suggests that using leverage is risky. So therefore, if you observe here, okay, we are exiting from the company of M Limited. M Limited is using leverage, and we are coming out of the M Limited. So therefore, we are avoiding the risk. So till that extent, you address the concern of Mr. B. Now the question is how to address the concern of Mr. C. What C says, without using leverage, the growth will be less. So therefore, what we should do, since we are going to invest in N Limited and N Limited is not using any leverage, N Limited is not taking any risk. So here the concept is that whether to take the risk or not, that is not irrelevant. What is important is you have to take the risk to get the returns, but up to what extent is the important point here. Okay, we thought that in the given problem, what is our assumption is that M Limited has got saturated. The leverage in M Limited has stopped generating excess returns. So therefore, we are moving from M Limited to N Limited. Okay, right. So N Limited is not using any leverage. Therefore, we have to use the leverage. The risk not taken by M Limited should be compensated by taking more risk on our own. Okay, we are investing in N Limited and N Limited is not taking any risk. If you don't take any risk, our growth will be less. Therefore, we have to compensate that risk. Here comes the substitution of shareholders leverage for the corporate leverage. Okay, right. So therefore, Mr. A cannot invest only 11,000 in N Limited, because what happens, N Limited is not taking any leverage. Therefore, he has to take the leverage. That is the important point. Okay, right. Therefore, next question. Okay, since N Limited is not using leverage, its growth will be less. To compensate that, Mr. A himself Mr. A himself has to use the leverage. In other, that is to say, shareholder leverage should be used as a substitute for corporate leverage, shareholders leverage should be used as a substitute, should use as a substitute for corporate leverage, right? now the concept is, earlier Mr. A is holding 10% shares of M Limited. Now if he wants to purchase the same 10% shares of N Limited, it took how much? It will take 20,000 money. N Limited value is 2 lakhs, the value of equity, because M Limited does not have debt, therefore M Limited has only value of equity. Okay, right. Value of equity of N Limited, is rupees 2 lakhs. So therefore the 10% investment in N Limited requires rupees 20,000. The value of equity of N Limited is rupees 2 lakhs. Therefore, 10% investment in N Limited requires 20,000. But how much I got is only 11,304. Then what I should do? I have to borrow the remaining amount. I am Mr. A as a shareholder. I am borrowing money. That means I myself is using leverage, because the company in which I have invested is not using the leverage. Therefore, I don't have any option. I have to use leverage on my own. That is the point. Okay. So here the balance amount he has to borrow. Okay. So the amount obtained by A. Okay, the amount obtained by A by selling the shares of N Limited is only 11,304, but he needs 20,000. Therefore, what he has to do? He has to borrow the remaining amount. Okay, therefore, Mr. A has to borrow rupees. Mr. A has to borrow rupees how much? So he got 20,000 is the requirement. Minus he got 11,304. He has to borrow 8,696. So Mr. A has to borrow rupees 8,696. Mr. A has to borrow 8,696. At what rate of interest? He has to borrow? At what rate of interest he can borrow? Depends on the market rate. But since the information is not given, Mr. A has to go to the bank and get and borrow the money, or Mr. A has to go to his friends or relatives, etc. How much rate of interest they will charge? That is not given in the question. Where A can borrow the amount and how much rate of interest A has to pay, that is not given in the question. So therefore, since the information is not given, what we are assuming is that M Limited has borrowed money of 1 lakh at 7% rate of interest in the market. M Limited has borrowed money of rupees 1 lakh at 7% rate of interest in the market. So therefore, now we are assuming that even A also can borrow the amount at same rate of interest in the market. If M Limited goes to the market and borrowing money 1 lakh at 7% rate of interest, now A also will go to the market and borrow 8,000 at the same rate of interest. In reality, this will not work out. The rate of interest which M has to pay will be more than 7%. M may not get borrowed funds at 7% rate of interest. Mr. A may not get borrowed funds at 7% rate of interest, because M Limited is a corporate. Okay, when a banker is giving a loan to the corporate, the risk may be less. When an individual is going to the banker and borrowing money, the risk may be more. Therefore, banker may charge higher rate of interest. In reality, banker may charge higher rate of interest. But in the absence of information, I cannot blindly add the 7 to 8% or 9%. I cannot add it. Therefore, comfortably, I'm taking 7%. For the sake of problems for solving convenience, I'm taking 7%. But remember, in reality, if M Limited goes to the bank and gets 7% rate of interest, and Mr. A goes to the bank and he may not get at 7% rate of interest, he may get at more rate and he may get at less rate also. M Limited is a very risky company. Banker has charged more amount. Okay, Mr. A is a very reputed businessman in the market. Many companies are giving loan to Mr. A. So therefore, no risk involved to Mr. A. Banker may charge less than 7%. Both are possible. But information is not given. Therefore, I'm avoiding all those complications. I'm simply assuming that A also can borrow at 7%. Since M Limited is able to borrow at 7% of the market, A also can borrow at 7%. That is my assumption. M Limited has to borrow at rupees 7%. Okay. So we are assuming that Mr. A also can borrow funds at the same rate of 7% as M Limited borrowed funds. Okay, therefore, so now Mr. A invests rupees 20,000. Mr. A will invest 20,000 in N Limited. Okay, right. Now Mr. A will invest rupees 20,000 in N Limited for purchasing 10% shares of N Limited. N Limited. Okay. In N Limited, earnings available to equity shareholders of N Limited is rupees 20,000. So since Mr. A is holding, so earnings to Mr. A will be rupees 2,000 because he was purchasing only 10%. So from that earnings, Mr. A has to pay interest of how much he has borrowed 8,696 in the market. He borrowed 8,696 in the market. Into 7% he has to pay. So 609 rupees he has to pay. Repay interest of rupees 609. Pay interest of rupees 609. How I got it? Rupees 8,696 into 7%. Okay. Okay, the net return available to Mr. A is equal to rupees 2,000 minus rupees 609 that is equal to how much? 1391. Okay, 2,000 minus 609, 1391. Now if you observe, A has not put even 1 rupee new additional investment. Whatever the earlier investment, the same investment is continued along with the borrowed funds. No additional investment from A's own pocket. Earlier, Mr. used to get, okay. Earlier, Mr. A return will be rupees how much ma? Will be how much? Earlier, Mr. A return will be 1,000. So no, what is the earlier A investment? Earlier, what is the earnings available to equity shareholder? 13,100. So earlier earnings available to equity shareholders is 13,000. Earnings available to equity shareholders is 13,000 in M Limited. Out of that, A is holding 10%. Therefore, A's return is 1,300. Earlier, Mr. A return will be rupees 1,300. So how we got 1,300? 13,000 into 10%. Okay. Earnings available to equity shareholders of M Limited is rupees 13,000. And A is holding a 10% shares. And A used to hold 10% shares. 10% shares of M Limited. So now A's return is rupees 1391. Because of using this arbitrage process, A is obtaining additional return of okay. By using this arbitrage process, Mr. A is able to generate additional return of rupees 91. As simple as that. Earlier he was getting 1,300. Now he was getting 1,391. Same thing. No additional investment. Sir, I borrowed 8,696. And I gave it to N Limited. That's it. I have not put additional investment. With the same investment of my earlier investment, I am able to generate more profit. So this is the concept of substituting corporate leverage, substituting shareholders leverage in the absence of corporate leverage. What is the concept, ma? Not the numericals. What is the concept going on here? Substituting shareholders leverage, using shareholders leverage as a substitute for corporate leverage. Using shareholders leverage as a substitute for corporate leverage. Okay, this is the point. Using shareholders leverage as a substitute for corporate leverage. So with one problem, you may get some clarity on this concept called as substitution of shareholders leverage for the corporate leverage. We'll do some more problems in the coming lectures. We'll do some more problems. Then you'll get the clarity. Okay. Thank you. Thank you all of you.